Welcome to our deep dive today. We're going to be tackling something that I think touches all of our lives, but it often feels very mysterious. The
hmm
Federal Reserve.
Yep.
What does it actually do, and how do its decisions sort of trickle down to impact you and me? We're going to unpack this using excerpts from a fascinating book called The Lords of Easy Money by Christopher Leonard. And it takes us behind the scenes of this powerful institution and its sometimes controversial actions.
I think what's interesting about the Fed is that while most people are aware of its existence, very few really understand just how much influence it has on the economy and, by extension, our daily lives.
Yeah, for sure. I mean, it's kind of like it's like this massive economic engine just humming away in the background,
Right.
and we're about to sort of take a peek under the hood.
Yeah.
So to set the stage, can you walk us through what makes the Fed so unique? I mean, it's not just a regular government agency, right?
No, absolutely not. It's actually a hybrid, part government agency, part private bank. And this unique structure was born out of this historical tension.
Hmm.
There was a deep-seated mistrust of centralized banking power among the American public. But also, there was this growing need for financial stability in the early 20th century.
Right.
So the Federal Reserve was created in 1913 as a sort of compromise, a way to balance the need for oversight with these concerns about too much concentrated power in one place.
Interesting. So it was a response to like very specific historical circumstances.
Exactly.
Now, one of the key things that we hear about the Fed is its ability to manipulate, or maybe manage is a better word, the money supply. How does it actually do that?
Well, one of the primary tools that the Fed uses is something called open market operations.
Okay.
And this essentially involves buying and selling U.S. Treasury bonds. When the Fed buys bonds, it injects money into the banking system, increasing the money supply, which tends to lower interest rates. And conversely, when it sells bonds, it pulls money out of circulation, which can raise interest rates.
Okay, so it's like this giant balancing act,
Exactly.
using these bond transactions to control the flow of money and influence interest rates.
Yeah, you got it.
And as we all know, interest rates affect so many things in our daily lives, right? I mean, from mortgages, car loans, to the returns we get on our savings.
Absolutely. Everything, yeah.
And that brings us to a pretty pivotal period in the Fed's history, the great inflation of the 1970s. So the Fed, under pressure to boost the economy, kept interest rates artificially low for a long time.
Yeah.
This led to a surge in demand, and prices just skyrocketed. It was a really tough time. The value of the dollar eroded. People struggled to keep up with that rising cost of living.
Yeah, it was a rough time for sure.
Yeah, it sounds like they were trying to stimulate growth, but they ended up fueling inflation instead. Like
Yeah.
a classic example of how well-intentioned policies can have really unintended consequences.
Yeah, you're absolutely right. And it took the decisive actions of Paul Volcker, who became Fed chairman in 1979, to really wrestle inflation under control.
Hmm.
His strategy involved raising interest rates to unprecedented levels,
Wow.
a move that, while painful in the short term, ultimately helped stabilize the economy in the long run.
So Volcker had to make some tough choices there, accepting short-term pain for the sake of long-term stability.
Yeah.
And it really highlights that balancing act that the Fed constantly faces,
Well,
right? Trying to encourage economic growth without letting inflation spiral out of control.
exactly, that's it. And speaking of navigating that challenge, the period following the Great Inflation saw the rise of another very influential figure, Alan Greenspan.
Mm.
His tenure as Fed chairman really marked the beginning of an era that's often characterized as one of easy money.
Oh, easy money. I've heard that term thrown around a lot. What exactly does it mean?
Yeah, that's a good question. In essence, it refers to a period of low interest rates and increased access to credit.
Okay.
So Greenspan, like a lot of economists of his time, believed that keeping interest rates low would stimulate economic growth. And his policies did contribute to a period of, sustained prosperity. But as we'll see, they also laid the groundwork for some pretty significant challenges down the road, including the 2008 financial crisis.
Ah, yes, the 2008 crisis. That's definitely a turning point that many of us remember vividly. How did Greenspan's policies, which seemed so successful at the time, how did they contribute to such a devastating event?
Well, one of the key factors was the way that low interest rates really fueled a boom in the housing market. Cheaper debt meant more people could afford to buy homes, driving up demand, and consequently prices. But this rapid rise in housing prices wasn't necessarily sustainable.
Right. It sounds like it created a classic asset bubble, right?
Really?
Where prices become inflated beyond their actual value.
Exactly.
And when that bubble burst, it triggered a cascade of problems that rippled through the entire financial system.
Yeah.
So while Greenspan's low interest rate policies may have seemed beneficial in the short term, they inadvertently sowed the seeds for a major economic crisis down the line.
Yeah, and it's a stark reminder that economic policies often have unintended consequences, especially when they interfere with market forces.
Yeah, it's all starting to make a lot more sense now. The Fed's actions, while well-intentioned, can have these far-reaching and sometimes unpredictable effects.
That's exactly right. And as we delve further into our exploration, we'll see how this theme of unintended consequences plays out time and again throughout the Fed's history.
Okay, this is already so much more insightful than any economics class I ever took, but I'm eager to hear more. So let's fast forward to the 2008 financial crisis. The system's on the verge of collapse. What does the Fed do?
Well, facing a crisis of unprecedented magnitude, the Fed decided to take unprecedented action. They rolled out a series of interventions that were designed to prevent a complete financial meltdown. One of these was the zero interest rate policy, or ZIRP. ZIRP, which essentially brought interest rates down to near zero.
So even lower than the easy money policies of the Greenspan era.
That's right.
Wow. I'm guessing this had a pretty significant impact on everyday borrowers, right?
Yeah, it did. For example, it meant that mortgages became much more affordable, as did other types of loans. But it also meant that people who relied on interest income from their savings saw those returns dwindle dramatically. So while it helped stimulate borrowing and spending, it also had its downsides.
So a trade-off as always.
Yeah, as always.
You mentioned another intervention, something called quantitative easing, or QE. What was that all about?
Yeah, so QE was a much more unconventional approach. It involved the Fed buying trillions of dollars worth of bonds from banks, flooding them with newly created money. The idea was that this would encourage banks to lend more and thus boost the economy.
It sounds like a pretty dramatic intervention, injecting that much money into the system. What were the effects of this QE program?
Well, it certainly had a significant impact, and the debate over its effectiveness continues to this day. Some argue that it helped prevent a deeper recession, while others point to potential long-term consequences, such as the creation of asset bubbles and increased inequality.
Okay, so QE was this really bold move with both potential benefits and risks. It seems like there's rarely a simple solution when it comes to managing the economy.
You're absolutely right. There rarely is.
And as we continue our deep dive, we'll see how these complexities play out in the years following the 2008 crisis.
For sure.
I'm all ears. Let's continue this journey.
Yeah, let's do it. Picking up where we left off those years following 2008, they saw the Fed continuing its unprecedented interventions. They implemented programs like the Paycheck Protection Program, or PPP, and that was aimed at, keeping businesses afloat during that economic turmoil.
Yes, the PPP, I remember that.
Right.
It was supposed to help businesses keep their employees on payroll during the crisis. It seemed like a good idea at the time.
It certainly was intended to be helpful.
Right.
However, upon closer examination, we see that a considerable portion of those funds actually went to larger corporations,
Oh, really?
while smaller businesses often struggled to even navigate the complex application process and didn't receive the aid they so desperately needed.
So even with programs designed to offer this broad support,
Right.
there can be these discrepancies in who ultimately benefits.
Unfortunately, that's a pattern we see quite often.
Right. It's like that saying, the rich get richer, even during a crisis.
Yeah, sadly, yeah. The Fed's actions, while aiming for this stability, can sometimes exacerbate these existing inequalities.
Yeah, for sure. And they also launched the Main Street lending program, right?
Yes.
That was specifically targeted at helping smaller businesses.
Yeah, you're right. The Main Street lending program was designed with smaller businesses in mind. However, it kind of became bogged down in these bureaucratic hurdles,
Oh, really?
making it difficult for many businesses to actually access those funds.
So another well-intentioned program that kind of encountered challenges in its implementation. It's fascinating how these large-scale interventions can have such varied impacts when you actually look at what's happening on the ground.
Indeed.
Yeah.
And amidst all of these interventions, another trend was taking shape.
Okay.
This growing disconnect between Wall Street and Main Street.
Right.
While the real economy was struggling, the stock market was experiencing this like remarkable boom.
Yes, I remember that. It seemed paradoxical at the time, the stock market's soaring while so many people are facing economic hardship.
Right. And this disparity was partly fueled by that search for yield that we discussed earlier.
Yeah.
With interest rates near zero, investors were hungry for returns and they poured money into the stock market, driving up prices.
Right.
This created a situation where asset prices were soaring, even as the broader economy lagged behind.
So the Fed's actions, while intended to stabilize the economy, may have inadvertently contributed to this disconnect between the financial markets and the everyday experiences of people on Main Street.
That's a really key point. And it raises some really important questions about who truly benefits from the Fed's interventions.
Right.
While they're often presented as necessary to save the economy,
Right.
the reality is that the benefits are not always evenly distributed.
It's crucial to look beyond the headlines and really examine those real-world impacts of these policies to see, who's being helped and who might be left behind.
Precisely. And this brings us to another really important aspect of the Fed's actions,
Okay.
their impact on wealth inequality.
Yeah, wealth inequality is a huge issue these days.
It is.
How has the Fed contributed to this problem?
Well, as we've discussed, the Fed's interventions, particularly quantitative easing, have this tendency to inflate asset prices.
Right.
And this primarily benefits those who already own assets, like stocks, bonds, and real estate.
So it's a system that seems to favor those who are already wealthy,
Yeah.
potentially widening the gap between the haves and the have-nots.
That's a very valid concern.
Yeah.
And it's one that has fueled a lot of debate about the Fed's role in society.
Right.
Some critics argue that the Fed's policies, while intended to, stabilize the economy, actually end up exacerbating these existing inequalities.
It's a complex issue for sure, and it really underscores the importance of understanding how these policies work and what their potential consequences might be.
Absolutely. And it's crucial to remember that the economy is not some abstract concept. It's made up of real people whose lives are directly impacted by these decisions.
Okay, so we've talked about the Fed's actions in the wake of 2008, the unintended consequences and the concerns about wealth inequality. But then came another major shock to the system, the pandemic. How did the Fed respond to this unprecedented crisis?
Well, when the pandemic hit, the Fed went into overdrive.
Wow.
They unleashed programs that dwarfed even those implemented during the 2008 crisis, pumping trillions of dollars into the economy in an attempt to prevent a complete collapse.
Trillions of dollars. It's hard to even comprehend what that means in practical terms.
It was an unprecedented level of intervention reflecting the severity of that economic crisis that was triggered by the pandemic.
Yeah.
But as we've seen in the past, these interventions, while aimed at providing relief, also had those unintended consequences.
So even in the face of a global pandemic, the same patterns emerge.
Yeah.
The Fed stepping in with these massive interventions, but those interventions potentially having those unforeseen and uneven impacts.
Yes, that's a key takeaway. And one of the most striking examples of this dynamic can be seen in the way that the pandemic bailouts impacted the wealth gap.
Okay, let's dig into that. How did the Fed's response to the pandemic affect wealth inequality?
Well, as we discussed earlier, the Fed's actions, particularly quantitative easing, have this tendency to inflate asset prices. And during the pandemic, this effect was amplified. As the Fed pumped trillions of dollars into the economy, asset prices soared, benefiting those who already owned assets: stocks, bonds, real estate.
So while many people were struggling with job losses and economic hardship, those who were already wealthy saw their wealth increase even further thanks to the Fed's interventions.
That's the argument many critics make. They point out that the pandemic bailouts, while providing some relief, primarily benefited asset owners and large corporations, further widening that gap between the rich and everyone else.
It's a sobering thought, and it raises questions about the long-term consequences of these policies. What happens when we create an economy that's increasingly reliant on the Fed to prop it up?
That's one of the most pressing questions facing economists and policymakers today. The pandemic has pushed the Fed into uncharted territory, and the long-term implications of its actions are still unknown.
It's like we're in this massive economic experiment, and we're not sure what the outcome will be.
That's a good way to put it. And as we continue our deep dive, we'll explore some of the potential risks and challenges associated with this new economic landscape.
We've been talking about how the Fed's response to the pandemic, while intended to help, might have actually widened the wealth gap. And it makes me think back to what we discussed earlier about Tom Hoenig,
Right.
the Fed official who was sounding the alarm bells about easy money policies long before the pandemic hit.
Yeah, you're right to connect those dots.
Yeah.
Hoenig's warnings become even more relevant when we consider those long-term consequences of the Fed's actions. He was particularly concerned about the potential for asset bubbles and financial instability,
Mhm.
arguing that, flooding the system with this cheap credit could lead to excessive risk-taking.
And we did see some signs of that even before the pandemic, right?
We did.
There were some warning tremors in the financial system.
Yes, absolutely. A prime example is the repo market meltdown of 2019.
The repo.
Yeah, this event, which, briefly sent these shockwaves through the financial world, revealed vulnerabilities that were directly linked to the Fed's years of quantitative easing.
Can you unpack that a bit for us?
Sure.
What is the repo market and how did QE contribute to its instability?
So the repo market, short for repurchase agreement market, is a crucial part of the financial system where banks lend to each other for very short periods, often overnight.
Okay.
It's essential for ensuring the smooth flow of funds and maintaining liquidity. However, the Fed's massive injections of cash through QE had created a situation where banks were flush with reserves, reducing their need to rely on the repo market.
So it's like creating a system where everyone has so much water that they forget how to use the well.
Right.
Then when there's a sudden drought, they're caught off guard.
That's a great analogy. That's essentially what happened in 2019. A sudden shortage of cash in the repo market exposed this underlying fragility, leading to a spike in borrowing costs and, a brief freeze in lending. It was a stark reminder that even seemingly technical aspects of the financial system can have these significant real-world consequences.
Yeah, it sounds like this domino effect where one seemingly small event can trigger this cascade of problems.
Exactly. And this episode really highlighted the risks associated with these prolonged periods of easy money and those challenges of unwinding those policies without causing disruptions.
Yeah, it seems like the Fed is constantly walking this tightrope,
Yeah.
trying to balance all of these competing objectives. Stimulating growth, controlling inflation, maintaining financial stability. And with each intervention, there's always that risk of these unintended consequences.
You got it. That's a great way to summarize the dilemma.
Yeah.
And it really underscores the importance of having these informed discussions about the Fed's role as policies and their impact on society.
Well, this deep dive has certainly given me a lot to think about. We've covered so much ground from the Fed's origins to its actions during various crises, the concept of easy money, and the potential consequences of prolonged intervention. It's clear that the Fed has this profound impact on our lives, even if we don't always see it directly.
Absolutely. And that's why it's so crucial to be informed. The more we understand about how the Fed works, the better equipped we are to engage in these important conversations about monetary policy and its impact on our economy and our society as a whole.
One of the most striking takeaways for me was learning just how much money the Fed injected into the banking system during that 2010-2011 quantitative easing program. It was more money in just 7 months than it had in the 30 years prior to 2008.
That's a powerful statistic. And it really highlights the scale and scope of the Fed's actions in recent decades. It also raises questions about whether these extraordinary measures are becoming the new normal and what the long-term implications of that might be.
So where do we go from here? What are the key questions we should be asking ourselves as citizens and participants in this really complex economic system?
I think one of the most important questions is, how do we ensure that the Fed's policies benefit everyone, not just a select few? How do we promote a more equitable distribution of the benefits of economic growth?
Yeah.
These are not easy questions to answer,
Right.
but they are essential to consider as we navigate this new economic landscape.
It's been a fascinating journey through the world of the Federal Reserve. We've seen how its decisions can shape our lives sometimes in unexpected ways. As we wrap up this deep dive, I encourage you to continue exploring these ideas, to stay informed about monetary policy, and to engage in this ongoing debate about the role of the Fed in our society. Because ultimately, the future of our economy depends on the choices we make both individually and collectively.
Did you get any of that?